If you're an ICT or SMC trader, you're gonna love this video because I will show you exactly how to put those concepts on steroids with a deeper level of market analysis and depth of information called order flow. You're probably familiar with fair value gaps, order blocks, bullish order flow, stop hunts, liquidity grabs. Well, all of this terminology comes from the world of order flow. And in the SMC space, you kind of try to simplify what is happening behind the scenes of orders interacting with each other without actually seeing those orders. But there's a way to do it. Instead of looking for an order block, you can actually look at blocks of orders in the forms of bubble in your charts to see where actually the big institutional trades happen. Instead of plotting your highs and lows for liquidity areas to hope that there will be stops up there, you can either plot actual liquidity areas with a heat map, or you can check with your own eyes if stops are being triggered in real time. And it goes even deeper than that. In this video, I'm going to show you exactly how to make your SMC strategy even more powerful thanks to real order flow data, and I'm going to share with you the exact template that you can use to copy and paste this chart on your Deep Charts platform as well, which, in case you haven't yet, you can go and check out with the link in the description. Now let's get real with order flow and liquidity. Let's start by making an overview of how to turn your most common ICT SMC concepts such as market structure, FVG, liquidity, and the pattern of the liquidity grabs, and what is for each its respective deeper version of market understanding thanks to order flow. Starting by the power of three, or the basic market structure understanding for SMC trader, which is accumulation, manipulation, and distribution, where at some point there will be a phase of accumulation and price is going to be quote unquote manipulated to induce traders to either short or close the long position, to then basically see a phase of distribution where basically price rises after they've basically fueled the move with liquidity that they've grabbed below here. And typically this happens in the Asian session, London session, New York session. And this is a framework that, regardless of the debates around liquidity, is not necessarily a bad framework to start with. But let's add a little bit of depth to it and kind of identify how a professional order flow trader would kind of analyze the same things, right? So we would start from a situation of fair value, right? For us, accumulation doesn't really matter if it's especially in the Asian session, because the most important type of accumulation is an accumulation that actually accumulates something. In this case, order, volume, position from smart money. And this is where typically you're going to see the big chunks of volumes as well, right? And where you're going to see the fair value areas or value areas. And throughout these areas of balance where the forces of the market, the market makers, the banks, the institution are agreeing on what's the fair price of the current trade. This is all, by the way, based on academical knowledge. Well, 70% of the time to 80% of the time, they're going to agree that this is the fair price, and most of the time price will be spent within ranges in most timeframes, by the way. This is not just for intraday like this good old AMD, but this works literally in every time frame. You can apply it in the daily as much as in the 4 hour, the 1 hour, the 5 minute, the 1 minute. Because of how liquidity works, there's going to be phases where there's a balance between the aggressive order flow coming inside of the marketplace and phases where that balance is not there. We call that imbalance. And this typically happens because there's an imbalance in these huge orders from market participants called meta orders, or sometimes you will see some bumps of effort, for example, in this case from buyers, to keep buying at higher and higher prices outside of the range, but then the same sellers that sold here, sold here, sold here, sold here, and sold throughout the entirety of this range because of something called implementation shortfall algorithms, or some types of best execution algorithms that typically intervene in the higher ends of price action. They will for sure start intervening here as well, and you're going to see price dropping back inside of balance and stay there a little bit more, sometimes do this spike below. So you're going to see these things called failed auction above and below, not necessarily in the lens of, hey, they're hunting for stop losses or they're hunting for liquidity, because most of the liquidity is going to be traded, as always, inside of the range. Most liquidity is traded here, and very little it's typically traded during these failed auctions. But at some point, again, an event might happen that shift the perception of what's the fair value, or the overall trend, for example, exhibits a net order flow delta that is bullish, at which point market will tend to agree on what's the new fair value of the price once either the new information or the new orders have been priced in. And so we'll get back to a situation of balance and consider these to be failed auctions. So instead of looking markets as a series of highs and lows, in volume analysis, we take a look at where the ranges are going. And if there are some discounts based on those ranges that we can monetize to either buy or in case we're bearish, so whenever you see and ranges dropping and fair valuation where the market agrees it's a fair price tending to go lower because the net order flow is bearish, when we see a premium compared to the current range, that's potentially an idea to sell, right? And this is the basic market structure. And this, by the way, comes from the main concept of liquidity, right? And the liquidity concepts inside of the smart money space, it's mostly buy stops and sell stops resting above highs and below lows, either in the form of market swing highs and lows, or in a consolidative environment, they're going to build up stop liquidity up and below this range, which is actually not a really bad idea. I mean, of course, there is going to be buy stops and sell stops above and below any high and low in the market, but that's just one side of the liquidity. How we understand liquidity as real order flow traders is there's always two sides of the liquidity. So there's going to be resting liquidity in the so-called order book, the so-called passive liquidity, and these are buy limits below the current level of price and sell limits above the current level of price. And these are what we call the market makers. And there's going to be some areas of liquidity, for example, this one, that it's highlighted, for example, in software like these ones, which are the heat maps that we're about to launch soon, by the way. And you're basically going to see these very hot areas that simply are liquidity areas that tend to attract price somehow. Because, yes, markets are always searching for liquidity because of the necessity from these huge operators to fill these huge orders. So they kind of prefer to do it at a favorable price where they know that there's some liquidity. So while they know that there's a little liquidity, there's a little bit of liquidity above highs and below lows, the most amount of liquidity is typically in the book. And they can be sure it's there because it's presented as a sell limit. So they can see it through the order book of the exchange if there's actually liquidity. And they can be fairly sure there's always a certain amount of liquidity at each price level thanks to market makers. But when it comes to stops, yeah, stop losses or buy stops and sell stops are not necessarily a big chunk of the liquidity, especially retails, because retails are like very, very small part of the party. And also these buy stops and sell stops, if they are there, they will come into the market in the form of market buy orders and market sell orders. Basically, buy market and sell market, which means that if this is the catalog of orders of passive liquidity, in what we call the auction dynamics, these aggressive buyer, so a person literally clicking buy market, and accepting to pay the spread, they're going to be filled here. So an aggressive buyers will be matched with passive sellers, passive sellers, passive sellers. And an aggressive seller instead will be matched with a passive buyer, passive buyer. So these, for example, buy stops will come in the form of these bubbles and gradually sweep away all of the liquidity from the book. So it's not the stops being swept away, it's actually this passive liquidity being swept away. So buy stops above a high will sweep the sell limits that are above a high. And this is slightly more nuanced, but this leads us to, for example, how to interpret the good old liquidity grab or stop hunt pattern when there's either a daily high, daily low, or a series of highs and lows, and that low is taken out, as in there is a breakout happening right below there, and typically that can be a strong supply or demand zone because we tend to be premium compared to where we traded the rest of the volume. And what SMC traders will typically do is say, hey, there's liquidity below here, so they hunted that liquidity, and it's very likely that they will go here. So I'm going to wait for price to move up, break out, and do the break of structure, and then position myself, for example, on a fair value gap. And then they're going to buy here, and maybe on the inversed fair value gap, whatever that is, or on the order block, and basically aim for being bullish. Well, regardless of how you trade this pattern, in order flow trading, we call this pattern a failed auction. Sellers tried to auction below, but then failed. And a failed auction has three slightly different, but very importantly different types. You have the very simple and basic stop run, where simply these bubbles come into the market and shift and they move price, creating this very fast inertia, also known as the F2 from Fabio. And they will create this run in price, which is very fast because they will sweep all of the liquidity in the book and basically move price. And typically a simple stop run, so an actual stop liquidity, in this case, sell stop liquidity squeeze that happens into the market, doesn't always lead to these kind of movements. It typically leads to just reabsorbing the short-term order flow imbalance created by these orders. So you're going to typically see price having this excursion and most of the time actually continuing the trend. Another version of the same pattern is the exhaustion, where we have stable volume throughout the entirety of the distribution. And when we move outside, we have a spike in volume that drops dramatically right away. So there seemed to be some interest in selling out, but there's not a lot of volume, not a lot of interest in keep trading at these prices. They're not really considered to be a fair price to trade by either side of the auction. So there's not a lot of trading really happening there. And instead, when price starts to raise up, you see volume increasing, indicating that it's likely that we're going to get back to an area of comfort, of fair value. And so this pattern typically leads to reaching somewhere around the other side of the range as soon as we move back inside of it, okay? And so as you can see, if a stop run, for example, will lead more or less price until here, until let's say the starting of the range, an exhaustion can lead up to the other side of the range. But the best and coolest and most important one is the absorption reversal, where through order flow you can see if by dropping below a very important low or a series of low, there is a very strong level of absorption where sellers are making a huge effort. Aggressive sellers are pushing the auction down, but they are being absorbed by a wall of big buyers. We're not talking about retails, we're talking about smart money. And so whenever we see that the absorption comes and then a reversal comes with big trades on the buy side, which means that buyers took control on the aggressive side, not only on the passive side, well, we just know that there's a higher chance that we will keep going higher, and there's not even a need necessarily to wait for a breakout, a test on the fair value gap, but you can also position yourself very aggressively at times right below here and have a great timing advantage compared to the rest of the ICT SMC traders. And finally, we get back to the fair value gap. The fair value gap is an idea behind the SMC space that basically says for how the algo works, you know, we can expect these fair value gaps to be respected, for example, tested, so that, you know, the algorithm will keep buying. And as a concept, you know, to keep it on in your strategy, as part of your strategy, I strongly advise in favor of this. Even though the explanation, you know, might not be necessarily factual at times, this is still a very powerful tool to use in your technical analysis. And as order flow traders, we define fair value gaps, and actually this is a pretty, I would say a pretty fair name, because the fair value, as was discussed, is when the market forces are agreeing in what's the fair price to trade, right? And when we get out of that situation of balance, we create a gap in fair value because we're not in fair value anymore. We're searching for new fair valuation, and that's why we call this price discovery, right? Because there's not really a fair valuation by both sides. There's one side of the market taking control of the auction and accepting to pay the spread, as we've discussed here, at higher and higher and higher prices. It's not because there's just more buyers. It's because buyers were considering these prices to be discount enough to keep buying at higher prices because they didn't just buy here and price moved. No, they kept buying here and 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 here, all the way over here. And we can see the effect of this buying pressure inside either the volume profile, if we're looking, for example, at long-term price action, for example, this can be the profile of a session or the TPO of a session, where you're going to have areas of fair value, right, and areas of imbalance and, let's say, an exit from fair value. So these are known as low volume nodes or single prints, and they were invented in the 80s, okay? This stuff has been around a long time before SMC were even a thing. And this is, for example, in the you would say the daily time frame, or when you're looking at the daily bias and this kind of stuff in long-term ideas. In the short-term order flow, for example, if you're down in the 1 minute time frame, in the 5 minute time frame, what we translate this into is an order flow imbalance. And we can track it not with candlesticks, but with numbers. The numbers, the orders that are behind the movement of each and every single candlestick that creates itself into the marketplace. And what you're going to see is not just an imbalance in terms of how much orders are executed there, or in terms of price, so a gap in price, but also in the terms of order flow. So if this number and this number relatively to each other, this one is way bigger, we define this as an order flow imbalance, because in that auction, and we consider the auction always diagonally, because there's always going to be the best ask as passive sellers and the best bid as passive buyer, and the auction always unfolds in these two levels, just as we explained here, right? Because here we exactly said this, right? There's the best ask, the best bid, so this is the passive buyer, the passive seller, and we always have buyers hitting the ask and sellers hitting the bid, right? So the exact same thing, we can see the result of these bubbles, but with numbers inside of the footprint chart. And whenever we see that there was more aggressive buying than aggressive selling at that point of the auction, that's what we call an imbalance. There's an imbalance here, there's an imbalance here. Here there's no imbalance because 10 and 8, that's not a huge imbalance, but 3 to 8, that's a strong imbalance. 8 to 15 as well, 5 to 20 as well. And so you can identify the exact level of the order flow imbalance and find these clusters of imbalances that are typically the exact fair value gaps. And you can be much, much more precise with where they are and basically enter with a way higher degree of precision, especially if then you consider other order flow confirmations during the test. But this is the sniper areas. This is absolutely phenomenal stuff, just like FV, but with even a better layer of precision. And this is how you can basically take SMC and put it on steroids with a deeper level of understanding market mechanics and using order flow. But let's get deep into the real deal. And talking about liquidity heat maps, this exact software is about to be launched. We're going to release it very soon together with a masterclass from me and Fabio Valentini, one of the best scalpers in the world, in the Robbins World Cup Trading Championships, where we're going to show you exactly how this tool works and how to use it to trade with all the information you need. So join the launch and the waitlist with the link you find in the description. Now back to liquidity. So now we kind of understand the theory, but let's get practical and let's take this amazing new template that we have built for you guys that are fond of SMC and you like the colors, you like the charts, and you like to keep, for example, the fair values. So we have a fair value identifier built just for you guys. Plus we have the good old session marker if you like to keep track of the Asian session, the London session, the highs and the lows of every single session there is, and also the important levels. So for example, the daily high, the daily low, and all of your good levels that you want to typically take a look at when you're trading SMC. Together with, for example, the overlay chart of the NASDAQ if you're looking, for example, for an SMT divergence. So you can have all of them in this template that you're going to find right below here. So as soon as you download Deep Charts, you can click on Templates, go on Shared, and right somewhere here you're going to see a new version. And either on the full version or on Orderflow version, you're going to click and you're going to see SMC series, and you're going to click and find this amazing template for you so that you can start trading with it right away. So let's see what happened in the last couple sessions. Well, you had your accumulation in the Asian session and in the London session. In the London session, then you had your area of manipulation. And for example, if you were to trade during the London session and use the big trades, what you can see here, for example, is exactly what I've just explained. we've seen a hike in volume on the way out, but right at the bottom, not a lot of volume. There was no interest in trading at these areas. So right around here, we can consider buying. And let's take a look at the deep trades and kind of lower the filter, because this is a filter for the New York session. But let's keep it a little bit lower, go to 50. There's going to be a lot of bubbles now, but let's try to find a nice filter for the London session, right? Let's maybe a little bit bigger. For example, let's say 100. Let's see how that looks. That's much better. Well, you can see it here in a very clear way that where instead you would expect price, for example, to reverse and then give you a test, from here you can see that a big seller has been absorbed at the bottom. And so right over here, when the next candle starts being bullish, that's your entry signal right there. Also because we're right where before we had the most amount of volume. So that's a really great area to trade at. Or let's get now back to the New York session and see how that would look like. So let's put our trades with 200. Let's do also 250 because the volume has been great recently. There's been a lot of big trades, a lot of volume. So let's see how that would have looked like. Well, with this filter specifically, you could have seen with your own eyes that if you take this as an example, this was no liquidity grab, even if price tested right away. Why? Because a huge seller here punched to the wall. You know, if you were just using candlestick, you would say, hey, we've swept the high and we're right back at where we started. Because also you can see there was a fair value gap here that got inverted. So this would be your, let's say, sell fair value gap. And you probably would have entered here in the test and then aimed to take, for example, the London session low. Also, you had a liquidity sweep during the London session. But here, when you look at order flow, you can clearly see that buyers are in control from this sell bubble. Because right after this huge seller entered the market, you had a big move in price up. And this is what we call an absorption and reversal. And you can also see the bubble here. That's your absorption and that's your initiative reversal. And you would be able, for example, to buy over here and then let the trade run. And maybe if you've inverted your bias, you can still have your fair value gap to evaluate the new entry. And so, for example, you would enter here. And so, for example, you would enter your first trade over here if you use order flow. You would spare yourself a stop loss in this case if you trade only with SMC. And only later you would get filled if you were using a simple fair value gap with a stop below here. So you would also have a way worse risk to reward ratio. But where do you put the targets, right? Because we're right close to, maybe daily highs or daily lows. But here, for example, you can clearly see that close to the end of the session, buyers were absorbed. So that's exactly when you want, for example, to exit, right? You can also have a clear indication of what's going to happen, a small reversal. Let's see the following session. Well, let's see what happened today. So today we had a huge seller right over here that got absorbed. And right after that, again, a huge effort from seller. Sellers dominating the auction, but then buyer taking control with the bubble. And as soon as buyer took control, boom, price pierced through any form of fair value gap there was. And then they came and tested it again. And now we're pretty much around here. As always, if you enjoyed this video, like and subscribe to see more order flow videos like this and comment with your favorite takeaway. And I'll see you at the launch of our heat map. And I'll see you in the next one.